Welcome back to The Long View. The smartest money just revealed its Q4 moves. At the same time, tech is selling off as AI threatens the entire software business models. And one high growth EV name is sitting right on the line between breakout and breakdown. This isn't random volatility. This is capital repositioning in real time. Today, we're going to break down some of the biggest 13F filings of the Q4 2025 season, dissecting what's actually happening beneath the surface of the tech sell-off and closing with a full bull versus bear debate on Neo. Welcome back, Mitch. Great to see you again. Looks like you got a bit of color down in Florida.
Yeah. It was beautiful weather. Great to be back. So I'm excited. We got a lot to talk about today.
Yeah, you haven't, it hasn't stopped raining here in Ireland, so I'm very jealous. But yeah, look, today we're starting to see the 13F files rolling through. The two big ones we studied that came out early before today is Ray Dalio's Bridgewater and George Soros Fund Management. So what I wanted to do to start off is I just wanted to show the viewers here today what we offer at TLI in one of our projects being the Money Flow Research Project. So at the end of each quarter, we analyze the super investors, as you know, the likes of Warren Buffett of Berkshire, Stanley Druckenmiller with his Duquesne family office, Bill Ackman, Steve Cohen, all these top guys in the market. And what we do is we try to identify what they are buying, how they're positioning, what sectors they like, and where they're accumulating. The point to note here is these 13Fs, they are lagging the market by about 45 days, right? So after each quarter, these investors then have to upload the 13F files onto the SEC website. The data is compiled, and that's how we sort of analyze how money and the flow of it has moved over the last couple of quarters. So on that note, what I would like to do is I'm hoping to jump into the money flow research. Caleb, if we could pull up one of our previous projects there, that would be great. Perfect. We'll just scroll to the top there to give the viewer an option. So this is it, the Money Flow Research. This is a Q3 take, Stanley Druckenmiller. So you can see there on the left-hand side, he had 3 sort of material buys and 5 sells. What we'll then do, and you can see on the first page, is we'll give a little bit of background about the investor, their investing style, their principles. Then we'll move on to all their buys, as you see here on screen. Now here we're looking at the portfolio. We break this down into a top 10, top 20 position. We look at what sectors they're investing in, and we look at the geographics of it too, okay? So if they're heavily invested in the US or outside. Now here you can see we dive into our buy side. So we'll look at each of these material buys, and you can see here that it will say what is the logic behind these buys, why are they buying? And then we'll proceed on, get down into our sales, our exits, our reduction to positions, and sort of see what way the portfolio is moving and where they're exiting, what sectors they do or don't like, stuff like that. And then we'll follow off with sort of a takeaway of what happened in this quarter for this investor and how they're positioning. So this is something we like to do at the end of each quarter. And as I said, we follow all the big guys. So today, because they came out early, we're going to just run through Dalio's Bridgewater, which he previously stepped away from, and George Soros' fund as well. So in the coming months, in the coming weeks, we will be covering the Warren Buffett Berkshire. Obviously, he stepped down. We'll be covering Steve Cohen, 0.72, Bill Ackman's Pershing Square, and all the guys on the market like this. So what you can do if you're interested, you can sign up to the Patreon. There's a free subscription service where you get a month free, and you can let us know what you think if you do sign up. But Mitch, on that note, I know that you covered George Soros and his fund for us today. Do you want to lead us through what you're seeing and what the Q4 period is suggesting and what the trends are?
Yeah, so kudos to Sean here for breaking down the money research flow. Obviously, it's important to kind of know where the big boys are kind of putting their money. They dictate the flows in the market. So just with Soros, kind of a quick breakdown. Like an overview, he leaned into more of the AI incumbents. So he trimmed a lot of the riskier SaaS positions and kind of layered in some macro hedges. His biggest 5 positions as of right now are Amazon. Sorry, excluding the hedges, are Amazon, I believe, at 6.3%. He's kind of leaning into the AWS plus AI infrastructure. And then we see that with his second biggest position in Google. Although he kind of reduced it after such a big run, I can't really blame him. Again, it's diversified. You have the cash flow, the search engine, the AI optionality. And then he leaned into more Mag 7s and Microsoft after its pretty solid pullback. AI monetization again via kind of Azure and Copilot. NVIDIA, it's the safest way to play, I think, the AI kind of revolution, so to speak. Obviously, Jensen's one of the best managers in the entire world, and it's obviously one of the biggest companies and most important in the market. So that's his direct kind of AI hardware exposure. And then if you look, which was interesting, because this is a 45-day lag, right? He added Salesforce, roughly almost 2%, I think 1.6% position. And so he's kind of betting on AI inside the workflows. So kind of in between the layers there. And obviously with this most recent software sell-off, I don't know if you
You're
would be
seeing the
thinking,
opposite.
yeah, we're seeing the opposite. And that was an interesting contrast there. So just moving into his trims, his biggest trim, but still a massive position, like I said, is Google. Probably just raising some cash. And then one of his big bets, he has a couple. They were more macro hedge based, like I said before. So he had a $415 million put on the SPY, the ETF, which is probably just an overall market hedge. I don't think he's expecting any sort of Armageddon. The interesting one that I thought was energy, because energy is a pretty big bottleneck right now. But maybe he just thought with oil prices coming down and Trump wanting lower prices that, again, it could be a good sector hedge. So he had 162 million worth short there. And these are probably more long dated. He had a semiconductor hedge. He had the ETF put it there as well, about 104 million. So he's definitely hedging the chip beta and any kind of weakness in that sector. And that was followed by CoreWeave, which, as we know, is directly one of NVIDIA's biggest holdings, but it is also a massive company in kind of the AI infrastructure build out. And they have a lot of debt on their books. So maybe he's piggybacking off that Oracle weakness, and CoreWeave stock obviously kind of IPO'd all the way at 180 and then has been dwindling down ever since. I think it's around 90. So again, he aggressively trimmed one more company in the SaaS space, and Snowflake, almost his entire position. He probably foresaw some weakness. And then last one was Datadog, which again, in that software space. So definitely probably contributed to some of the selling we've been seeing recently. So just some notable moves there.
Yeah, a lot of software names, big tech names that will probably lead us into our next topic. For the moment, I'm seeing some similar narrative and commentary across Bridgewater. So just to pull up a couple of my notes here in the background, Bridgewater was obviously founded by Dalio, who sort of stepped aside more recently. However, Dalio has gone viral over the last couple of months just on debt cycles, reserve currencies, and structural instabilities. However, his fund continues to execute buys and build positions that suggest otherwise. So looking at the Q4 25, his biggest buy was the S&P 500. He bought the ticker SPY, which is a State Street ETF. So he spent 1.3 billion here. This position he increased from 6.7 to 11.1% of his portfolio. So a big bet on sort of the biggest 500 companies in the US, right? Whether you want to say that's more heavily focused on Mag 7 and AI and tech at the moment. But another interesting one, his second position, not a second buy, but his second position in the portfolio is the IVV, which is a BlackRock S&P 500 ETF too. So when you add these two positions together, it brings the portfolio to 23% based on the S&P. So that's a pretty high percentage to have straight in an ETF. I guess the alpha play belows are the Mag 7 and the NVIDIAs and stuff like that, which we'll get to. So there's no reductions to any of the S&P 500 holdings that he has, and he sort of doubled down. He appears to be and remain bullish. Bridgewater remain bullish on the US economy. Their second biggest buy was Oracle. They spent 286 billion. So ticker ORCL. I guess they saw an opportunity in Q4 with the pullback and with the share coming to a more meaningful price where they can increase their position at a lower average cost. So they boosted their holding here by approximately 361%, bringing its average estimated price of purchase to $234. So obviously they were buying well below that, and it's sort of bringing their average cost down. So it looks like they can see a lot of conviction, they have conviction around Oracle's long-term growth prospects, the remaining performance obligations, and sort of the continued expansion in the data center and infrastructure play there. Very well-timed buy here. His third biggest buy was Micron Technology, 253 million, ticker MU. So Bridgewater have identified the sort of bottleneck in the AI industry around memory, and they bought up here heavy in Q4. So The firm initially began accumulating in Q3, but at a very immaterial level, and more materially they bought in Q4. So their purchase price per share is around the $200 mark. I think 209 is what it's estimated at, and that's now trading well above 400. So a well-timed buy here where they've nearly doubled their money in, I guess, 1 quarter or so. Their fourth biggest buy was Nvidia, so continuing the trend in sort of the AI infrastructure play out. Here they're looking at chip design. So this is their largest alpha play in the portfolio after position 1 and position 2 being the S&P 500 ETFs. So they have increased the size of their Nvidia play to 3% of the total portfolio. And Bridgewater obviously have confidence in NVIDIA's long-run leadership in the AI ecosystem. So they're sort of disregarding this initial AI bubble concern, and they're investing in the monetizing layer of the AI play. So the next one, their fifth most material buy, will probably echo what Dalio is saying in the market. They have invested in Newmont Corp. They bought 192 million worth of stock. So just for people who don't know, Newmont Corporation is the world's largest mining company. It's got exposure to gold, copper, silver, zinc, and lead. And they've increased their position here really materially by 500%. So this aligns with Dalio's public comments where gold ownership and concerns of the debt crisis and macroeconomic risk is a good play. Interestingly, they also bought more shares in Barrick Mining during the quarter, and they increased their ownership here by 300% too. So it's obviously an area they're very bullish in. So looking at these 5 buys, a lot of them are AI based, right? And reference to Mag 7, Bridgewater holds all of the Mag 7 materially, with exception to Tesla. Apple a little bit more minor. Nvidia is their most valuable alpha play, and Google, Microsoft, and Amazon are also in their top 10 holdings. In terms of the sells, like Soros's fund, Alphabet was the biggest trim. So they trimmed 333 million worth. Allegedly, that's the amount from the 13Fs. We can't actually specify the total amount, but that's the sort of the average calculation. They reduced their position here by 40%. Now, while this is a very material amount, it's still the 4th highest play in their portfolio. And I guess what this says is if we look at their average cost, it was initially $140, $150, and it's traded above 310 at the end of the quarter. So they're probably just crystallizing some profits, and they also have defined parameters of where they want to keep Google within their portfolio, and they're just maintaining their portfolio in that manner and redeploying this capital into alternative, better risk reward opportunities. Their second biggest sale was Fiserv, ticker FISV. They sold 220 million worth. I can see why. The fintech payment company lost about 75% over the last 12 months and 11% in the last month alone. And I guess it's probably just growing frustration here post material earning misses, strong guidance cut, and executive change. Their third biggest sale was Uber Technologies, and they sold 189 million worth. I think this is a position that sort of frustrated them since they first bought in early 2022. They're now selling only around break even. I think there's $2 in the difference of their average buy price and their average sell price. So I think a position that frustrated them. You probably have to look here and question not the future of Uber, but the competition with self-driving cars, robo-taxis, and humanoid robotics coming out. So I think that's probably leaning in here on Uber, despite the strong user metrics. And I guess Bridgewater have reduced this position by about 65% in total. Their fourth biggest sell was Wells Fargo. They reduced position by 130 million, which is approximately 55%. And I'm guessing the reason here is sort of the changing expectations around the interest rate environment. So these anticipated cuts in the year ahead will compress net margins, lower spreads on earnings momentum across the sector. And there's probably better alternative investments here and sort of the likes of JP Morgan, Morgan Stanley with deals and M&A more likely to bring in more revenue and sort of higher earnings over the year ahead. The fifth trim was also Meta Platforms, 128 million, 50% reduction in position. Average entry was 430 per share, and it looks like they sold in around the 660 mark. So is this a profit realization? Are they worried about the CapEx spend? It could be either of them. And look, they're potentially favoring alternative infrastructure plays and redirecting that money into the likes of an Oracle, which we saw, which was a pretty high conviction alpha play and buy there too. So
Definitely.
that's what I'm seeing across the Bridgewater profile.
Yeah.
Any initial thoughts on it?
Yeah, I think it's important to kind of note. So, two things. One, I remember last year, Chamath made a good point. He said, well, I mean, it didn't age well. He said, long the Mag 7, short the S&P. And I think he was 1 year kind of late, because now it seems that a lot of these guys are still longing the Mag 7 or shorting the S&P. Obviously, Bridgewater sees it differently, but maybe that's more from a geopolitical standpoint. They kind of want more stability in the ETFs. But if the underlying economy also gets going, the rest, the 493, should also do well. So just some interesting contrast that I noticed there.
Yeah. The Bridgewater portfolio, we can run through the top 20 if you like, but the AI play in infrastructure, there's a big focus on semiconductors, manufacturing equipment, the hardware. They got Lam Research in their second most high profile, most high conviction play after NVIDIA. They got Broadcom, NVIDIA, AMD, ASML too. So, and obviously I mentioned they bought Oracle, they bought Micron Technology. So the Bridgewater portfolio isn't concerned with this AI bubble at the moment. They're still heavily involved in it. Again, they did trim Meta and they did trim Google. So.
Yeah. I saw Tepper today. Excuse me. His our portfolio was released, and he had Micron from around the 160 mark. So he's done well. They identified that bottleneck, and then I believe he sold out of Whirlpool. So some of these guys, they do quick trades. So you kind of have to, like, it was his third biggest position last quarter, and then he's already out of it this one. So you can't follow these trades and kind of shadow their portfolio because of that delay. And again, a good lesson there is that even Bridgewater, they kind of get impatient, or they change theses with Uber, right? Not everything's a winner, and then they kind of adjust accordingly.
Yeah. Well, look, Mitch, all this talk is actually getting me excited for sort of getting back on the money flow research project. And for anyone watching here today and is a member of our TLI Patreon group, comment below and let us know which one of the super investors you'd like us to get into first, where you'd like us to run through in more detail. We'll get that out to you in the coming week or so. What I'd like to do now is sort of pivot on and move to the recent tech sell-off. I guess now is a good time when we're seeing these super investors sort of picking and choosing their plays, right? And I guess over the last couple of weeks, just to add some context, investors are getting increasingly nervous that the likes of agentic AI and the new capabilities can do the work currently done by traditional software products, and threatening those companies' future profits, right? And one of the big things here is if you look at the iShares Tech Software ETF, ticker IGV, over the past 3 months, that's down about 24%. And we have companies like Workday and Salesforce that are sort of, over the last few weeks, nearly experiencing an existential crisis in their share price. So, look, just wanted to get your thoughts on it and see if you could run us through it a little bit.
Yeah, I was excited to get to this because it's kind of been the talk of the street right now. I mean, it's kind of pure carnage across the whole entire software sector. And I think there's a couple ways we can look at this. So obviously it started because of the Claude agentic AI shift, the plugin that came out. It was more about executing end-to-end workflows. There was tweets with building financial models, documents autonomously. Sorry, they were chaining multi-step tasks across a bunch of applications. So there's a couple things that we can note. Jensen came on and he kind of tried to calm the nerves of everyone, and he made a good point. He said, if I was everything agentic, okay, and I was a robot and I knew everything and I had LLMs running through me and I was the agentic, the perfect agentic body, and I needed to screw something into the wall, would I pick up a screwdriver and do it, or would I go and invent a new screwdriver? I have the capabilities of doing it, but no, I want to use that tool. And so his point was that software is a tool and that AI can be built on top of it as another layer, but it's not going to necessarily disrupt software. So I see kind of his point, but I also do see the market's point of view. And so what we have to keep in mind is that software has usually been a high margin, high free cash flow business when they're matured. And with that, you get really expensive multiples. So, for example, I don't know if CrowdStrike's trading at this, but just for fictional purposes, if CrowdStrike was trading at 30 times free cash flow, and all of a sudden AI comes out and you don't know that certainty, like we talked about last week, you have to apply a higher discount rate and the multiple is going to come down because that visibility, you can't see 30 years into the future what their free cash flow is going to look like. You might only argue that you could see 15 or 10 years. And so that multiple has to compress. And with a lot of these kind of high flying software names where they were expensive to begin with, well, they're going to have to compress and their share prices are coming down 40, 50, 60% all over the board. So I think one of the things there is that you have to really understand the sector well, first of all. You have to know the leaders, you have to know their capabilities inside the businesses and kind of see if they're really going to actually be disrupted or not. So I think today the ServiceNow CEO Bill McDermott came out and bought 3 million worth of his company shares, and they kind of canceled all insider 10B filings. So that kind of speaks volumes to what he's seeing. I didn't know if you wanted to touch on anything.
Yeah, I think you
that as well.
covered it pretty well. I think one of the key points you're touching on here is valuations, right? And these software companies, they have locked in future cash flows, they have annual recurring revenues, right? And this is why they can trade at those elevated multiples. But when that's challenged, what we're seeing is that multiple compression. Okay, so the profitability side of how you value a company is coming down. They're not. If they said, as you said, CrowdStrike, let's assume it trades at 30 times forward earnings, they're saying, well, hang on, will CrowdStrike still be trading in 30 years' time? Will agentic AI, will all these upgrades, will that render their business model redundant? And that's the big question that's shaking up the market at the moment. You can also think about in the cash flows. Those cash flows, they mightn't be as competitive in a few years. There will be more competition, and you're sort of looking at it going, what we're projecting in cash flows now, will that really be the case in a few years' time? So I think the important thing here is you've said to me during the week that everything is getting thrown out in the bathwater. And it's a narrative I really like, okay? And it got me thinking more about it. I think we need to break down sort of what tech is, the different subsectors, okay? And we can just talk through how each of them are affected, whether we expect them to thrive, whether it's a mixed impact or whether it's sort of a high risk or a disruption area, right? So if we look at it, if we start with sort of the hardware side of tech, okay, if we look at semiconductors, design equipment like that, so your NVIDIA's, AMD, Qualcomm, Broadcom,
Yeah.
ASML. Personally, I'm looking at that saying, okay, if we expect AI to continue at this level of growth, we need the hardware build out. Okay. So that's an area personally I expect to continue thriving within tech. An area you might add some context for us here, like enterprise software and SaaS. So the likes of Salesforce,
Yeah.
ServiceNow, Workday. What are your
Yeah.
thoughts here?
Yeah. So, I mean, they're definitely the most exposed to kind of revenue model uncertainty. Like you look at, I saw a funny post. It was just kind of someone basically creating their own Adobe. And they said, can we create our own Adobe Photoshop? And he spent, I think it was like 6 hours and 450,000 or 45,000 lines of code. And he had his own Photoshop. Now, I don't know if someone's going to actually go and vibe code it and go and take over Adobe's business because Adobe also has plugins, a large moat, and they can build on top of their software. But those are the kind of things that the market you think, oh, wait, okay, well, maybe that is possible in time. It doesn't have to happen right now. But if you're seeing also as well, the gentleman who just sold his, I think it was Claudebook or Moltbot, though he invented the Claude bots essentially, and sold it for $1 billion to Sam Altman. It was just him, like a one-man $1 billion company in software. So when things like that start popping up, the market's going to second guess. So obviously in the enterprise SaaS space, they have a lot of seat compression. Their workflow and automation risk is under threat, and obviously their valuations are the most sensitive to that. I don't know if you wanted to kind of touch on the hyperscalers there and maybe how they're a bit more shielded.
Yeah, so cloud hyperscalers, if you look at it, Microsoft, Amazon, Google, the hyperscale play is central to the deployment of all AI, whether it's, as we know today, with the large language models, the chatbots, or the agentic that could replace certain areas here. If you don't have the hyperscalers, if you don't have the data centers, if you don't have the memory, you don't have the AI. So this is like the semiconductor design and equipment. I think this is an area that thrives What do you think about that?
Yeah, they're gonna thrive. I mean, less disruption risk. They do have the heavy capex burden, but still, like short-term margin pressure might be one of the things that I would look for. But they're
Yeah.
still kind of so structurally advantaged long term. And then the one I also
Something,
want. Sorry, go ahead.
something we did touch on there, and I'm sorry for cutting you off, but I just want to touch on it before we move on. I think we mentioned in one of our previous videos is you said that the leaders of the Mag 7 are seeing the most relevant real-time data in the market. And that's why they're doing this build out, right? And they're obviously seeing that some elements of tech and software can be replaced, but the hyperscalers, the data centers, this is an area that will need to be around for the long run, right? So I think that answers the question that how do we see their future going? And they're going to be the basis and the central point of how all the AI operates in the future.
Yeah, definitely. No, 100%. I think you kind of covered that. I
Yeah.
think the last subsector that I wanted to touch on was the cybersecurity names.
Yep.
Uh, Personally, I think the cybersecurity names, it's mixed. It's a mixed bag. There is a threat to them, but it's a lot more complex, and some detection layers might get commoditized, but they're definitely way more defensible than generic SaaS plays just because of the government contracts, the amount of data that they've acquired over the past 10 to 15 to 20 years. If I'm a government, Pentagon, whatever it is, and I need to encrypt some pretty high classified data or whatever it is in a company, I'm not going to rip out the guts, so to speak, stop using CrowdStrike or Palo Alto or whatever they are, and just hop onto a random vibe coded cybersecurity platform that someone
Yeah.
made. So I
Yeah.
think they're a bit more defensible.
100% on that. If you think about it, right? So let's say me and you are working in an office tomorrow and a salesman comes in and he says, look, you use this SaaS. Here's a plug-in agentic AI model that will completely replace that. Here's your cost savings. You're going to save 5 million a year. If you say that to a company and it can improve their day-to-day service, they're going to jump at it. If you say that to someone like a government or someone that has sort of highly sensitive data, even the cost savings, they can't switch straight away, right? So with cybersecurity, they need something that's tried and tested. They can't go out on a whim and try something new. They have to stay with a system that they know they can trust, that can't be hacked. And let's say they put their faith in something like AI in order to be that cybersecurity layer. The system isn't very tried and tested. And that's the point
Exactly.
there, that the cybersecurity, yes, there is a disruption risk. It's lower than the other areas in the tech play, but you can probably also use the AI in these cybersecurity companies to add on a value there.
That's a great
So
point. Yeah, that's a great point. I was just going to say, sorry, when you think about that as well, AI, we still don't know what it is yet, almost like what it can become. It sounds funny, but you kind of, some people get this like Terminator type futuristic worldview of AI. And all of a sudden, if it's protecting your most sensitive data and it's not regulated properly, there's no laws or anything pushed, the rails or the guardrails aren't clearly set in the parameters. I'm not going to say that it's a doom and gloom scenario, but you open the door for that possibility sometime in the future, especially as agentic comes along and AI can start communicating amongst itself with other AI bots and then create those parameters. So I think it makes me sleep better at night knowing that we have cybersecurity companies that have been tried and tested, and we're not just going to throw new AI programs in there and say, hey, we're switching everything right now.
yeah. Question I wanted to ask you. We had discussed it during the week off camera. I had always said that where we are in the market now, I like comfort in hardware of the tech play. So I think the evolution of the trade initially started in the software. For me, it's moved to hardware. And you had previously mentioned that, look, what's behind all that? And it's got to be energy eventually. So just wanted you to maybe add some context there because it was very helpful to express that to me sort of during the week. And I think there's some value in that for everyone watching here today too.
Yeah, I think it's just it seems to be moving downstream more and more. So obviously software, initial market euphoria, some names ran. And then you kind of moved to that hardware and like it kind of went through each bottleneck. And what sector has been historically the most unowned in the past 5, 6 years as this tech bull rally has kind of really taken off? It's been energy. I mean, Chevron, Exxon, all these companies were fine, they were doing well, but the allocations from the hedge funds and the ETFs and everyone was down to low record or to below anything worth like owning it almost like to like obscene levels that we haven't seen before, if that makes sense. So I think when you think about how much energy is actually needed, we're still valued at low levels. Even if it's 25 times earnings on some of these names, they can expand and they have room for that multiple expansion where some of these tech names are getting frothy and they don't. And interestingly enough, I listened to Sam Altman talk about this, and the interviewer was talking to him and they said, Sam, like, what's happening here with energy? Where are we going to get this from? And he said, short term, right now, we're going to have to turn to natural gas. That is going to be our most important ally, essentially, in the energy space. And then he said, long term, it's probably going to be solar. And what I took away from that, which is interesting, is it wasn't nuclear. I thought he was going to say nuclear for sure, but there's so many rules and regulations with building nuclear. And I think China is so far ahead right now of the US of that I don't think the US thinks they can really catch up as of right now. And so,
Yeah.
and then you got Elon also coming out and saying AI data centers in space. And he's thinking even further outside the box, even ahead of China, and saying, okay, well, maybe this can work and reduce costs, so
You
it's
gotta love
definitely something. Yeah, you gotta love it. I mean, he's just insane.
Yeah, no, very helpful. Thank you very much for that. Look, I think just sort of the takeaway here is while we acknowledge the concerns that AI can replace the services provided by many software companies, investors need to dissect the tech industry as a whole and identify what areas will benefit and thrive and sort of versus the subsectors that are higher risk and may become redundant. So once investors understand this, they can position themselves better for the long run with a lower risk profile and identify positions in high quality tech names that will very likely make a rebound. Because as you said, everything tech is getting thrown out with the bad waters. So there's a couple of high quality names out there that I'm keeping an eye on too.
Yeah, definitely. I think that's the next place to look here because it will end eventually. And when it happens, there's going to be some great deals.
Yeah. Look, good time to pivot on to our final topic. So, to show that we've been listening to our viewers, in each of our podcasts, we usually do a bull versus bear debate. And in the last one, we asked for some suggestions. And reading in through the comments, people were saying that they wanted to see Neo discussed. Okay. So, I think it's quite a good one to have a go at. It's very heavily debated in a bull versus bear context because it's just on that verge of profitability.
Yep.
So look, I'm happy to take the bull case, and I think you're going to take the bear case, and we'll wrestle it out.
Yeah. I mean, run us through the bull case here. I'm happy to hear it and try to rebuttal.
Right. So I think the thing for me when I look at Neo, where it is in the market, I'm looking at the rate of compounded annual growth. Okay. So just to throw figures at you, Neo delivered its latest quarter for Q3, they delivered 87,000 electric vehicles, right?
Yep.
And if you look at how this number has grown over the last 7 years, the annual compounding growth rate per year is 60% in EVs. So that's a huge level to grow at each year by 60%. Obviously, that slows. And in the last year, the last 12 months, it still grew by 41%. So we're still seeing consistently high growth levels of EV delivery. And I would argue that if you saw this across any company in financials or consumer staples, this would be a stock that you're going, there's a lot of value to be added here if they continue these growth rates. So that's sort of an incredibly impressive area of the buy thesis. And this links in obviously to the revenue growth. So over that 7-year period, the annual compounded average increase in revenue per year is 53%. So EV deliveries grown 60% per year over 7 years and revenue growing 53% per year over 7 years. So it's very positive to see them carrying through. And just to put that into context, if you think of Tesla, I think a lot of my examples are going to be compared to Tesla here because it's just a company I'm more familiar with and I like, and it's in the news every day. Their compounded average growth rate of revenue across this time is 24%. Of EV deliveries, not revenue, is 24% per year. So it's a much higher growth rate. Granted, they are not out delivering Tesla, but you're sort of paying for that continued growth expectation. So that is my compounding annual growth rate argument. My next argument is the margin profile. So NIO's latest Q3, they achieved a vehicle margin of 14.7%. If you look at this 6 years ago, it was minus 6.8%, right? So they've nearly done a 22 percentage point swing in 7 years. Tesla's currently at 17, okay? The reason I'm benchmarking about Tesla is obviously it has a huge market cap. Look, that's valued on future optionality, humanoid robotics, the future, granted. But it's still a good level to compare, right? Because it's what the Western investor knows best and drives and company-wise. So currently at 14.7, Tesla at 17.1. There's an argument here that there could be an acceleration of this margin while Tesla's also sort of goes backwards. And this falls on the grant environment. So while the US grants have been tightening and President Trump took away the federal tax cuts and the subsidies, China is consistently providing subsidies, tax breaks, and R&D tax credits, right? So I think that's going to lead to benefit NIO and their production and their vehicle margin. China is also carefully positioning in a critical mineral and rare earth race. A lot of these materials are needed in EVs, be it the battery and the build out and, everything like that. So I think the US is going to feel a bit more of a squeeze there, while Chinese manufacturers are perhaps getting a better hand dealt to them. Now, look, that's across all EV manufacturers, is not just NIO in China, of course. So I think the vehicle margin profile, huge growth over the last 6 years, 22% swing, and it could overtake Tesla in the long run, especially if Tesla lose focus on their margins when they're building out their humanoid robotics. The operating margin, while still negative and I guess concerning, in general, it averages around minus 30 to minus 35%. And you can say, how are you getting the bull point out of this? But their latest quarter did drop to minus 16, right? So that's still negative. But there's a lot of things here that you could argue won't be there in the future, right? So they had a loss of 488 million. They spent 435 on R&D. So 50 million there, that's profit. On top of that, in selling administrative expenses, they spent 600 million. So all of a sudden, that's a 1 billion swing on a 488 million loss, right? And these are costs in marketing, advertising. Then they got to come down as a firm grows its name and its brand. So these initial setup costs that the firm is building out and getting its presence out there. So that brings me on to my third point, right? So you have the top line compounding growth, you have the margin profile accelerating. If NIO turns a profit, the whole stock completely re-rates, right? And I think very much the worst case scenario is now priced in. So I think we've seen NIO in the last year trade around $8. It's currently around $5 mark. If this has a positive quarter, if that's sustained, if it sort of quells those concerns, we're going to see a trading above $10, $12. And I think that's the bullish point of it, right? That a re-rating here depends on the profitability. And you can argue if the revenue continues at that rate, green tick. If the margin profile continues, green tick. And the sort of macroeconomic backdrop as well is favorable too. My last point. So now I'm going to look operationally. So NIO does some things that many other EV manufacturers don't do. So their battery advantage is they can sell a car without a battery, okay? And that will reduce the price of the car by 30 to 40%. So there's that flexibility that makes it more affordable. Now, what they alternatively do is they can then lease batteries out. So it's a sort of another revenue stream, battery as a service, okay, which I really like. That adds flexibility, it adds leasing options, it adds reoccurring revenue, which we're seeing flowing through, and it gives flexibility to the buyer. Another area I like in their operational advantage is these battery swapping stations, right? So in China, there's large capex spend. You drive into what appears to be similar to a car wash. Your battery's low. You stick it into the system, it says drive here, and within 2 minutes, it will replace your battery. So it'll pick the car up, take the battery out, swap it around, and give you a new battery. And what consumers like about this is it reduces they call it range anxiety of, will I make it? Have I charged the car? So it's this, you can charge your car at home, but if you're out and about and you need to change it, you can go into one of these battery stations, swap your battery, and it's the same price as a tank of fuel. So I really like that as well from an operational advantage. So in summary, financially, you're seeing top line growth, consistent growth in EV deliveries. You're seeing a better margin profile, structural background, macroeconomic backdrop. And then from a battery standpoint, you're seeing the operational benefits too. So just on top of all that, I think if Neo sustains a profitable quarter for a couple of periods, the stock completely re-rates, and it's very much a bull case.
Okay. Well, thank you for that. First of all, I think that was well said. It's going to be harder to rebuttal than I thought. So good job. No, I think honestly, if I'm looking at Neo from that perspective as well, I do agree that the multiple is compressed. The stock has come down quite a bit, and so there is a case to be made for that bull side. So if I'm taking the bear side, though, I have 6 points. So I'm going to touch on growth, margins, operating leverage, balance sheet, the multi-brand kind of execution risk, and then the industry, and kind of just break down the structure risk there. So from the growth side, yes, they had the deliveries were, I think, 87,000, like you said, and it was 41% year over year. The revenue was up 17%, but their net loss was still 490 million. So what this kind of tells me is that the delivery growth, while being material, it is growing ahead of their revenue growth. So that is the early signs of the average selling price compression already showing up. And if deliveries grow, say 30 to 40% and revenue only grows mid-teens, then pricing power is deteriorating, is what that's telling me. And when you're in a structural industry, which I'll get on later, where China is uber competitive, the last thing you want to do is be in a race to the bottom for the price. And I think China is notorious for that. And I think Tesla experienced some of that and they're getting squeezed out of it. And when you're in a industry that's already very low margins and notoriously hard, it's only going to get more difficult. And with BYD being there and XPEV or XPeng, sorry, and all these other companies, that's going to be difficult. So from the margin standpoint, they are improving. The vehicle margins were, I think, 14.7% and gross margins were 13.9%, which is close to Tesla's 17%. But if you kind of break down why that would matter, BYD again controls scale economics, and Tesla has again shown willingness to kind of cut prices aggressively. So just some math here. If the industry pricing resets even 5%, Neo's margin would compress back to, I think, 10 to 12%. And then at 10 to 12%, your vehicle margin and profitability is pushed out multiple years. And then what happens is they have to raise capital and you have dilution. And as a shareholder, you obviously don't want that. You want to see profitability and cash flows. So that brings me to my next point, which would be their operating leverage. So to break even quarterly, their R&D was 2.4 billion RMB. Their SG&A was 4.2 billion, and they had an operating loss of 3.5 billion, I believe, last quarter. Yeah, in Q3.
Yeah. In dollars, if you wanted there, the operating loss 488 million,
Yeah.
the R&D 435, and the selling general admin 600.
Yeah, exactly. So thank you. So to have a break-even quarter, they would need the vehicle margin above 17%. Their deliveries sustainably would have to be over 100K per quarter. Their SG&A would have to come down across all three brands. So even at 400K annual deliveries, if margin stalls even a little bit to 14 to 15%, operating profit is very, very slim there. So their leverage just isn't there. And I would argue that there's not only just better plays to play the EV race there, but there is, again, that structural squeeze that's coming. So the balance sheet, although it's fine, it's not bulletproof. They have cash of, I think, $5 billion. Their liabilities are around 100 billion RMB, which I think is roughly twice as much. They do have an equity cushion because they raised 1.1 billion in equity in 2025 again, but their burn rate is roughly 3 to 4 billion RMB per quarter, which roughly implies only 2 to 3 years of runaway. So if you assume no deterioration in any margins, that is assuming no deterioration in margins, but if profitability doesn't arrive by 2027, you're getting diluted, and then the per share value kind of becomes a bigger risk. Moving on to like the kind of brand expansion, they now have Neo Premium, they have Onvo, which is I think their family line, and they have Firefly, which is like their more compact line. So instead of consolidating again those margins, they're kind of expanding the company in complexity, which means there's more SKUs, more marketing, more capex, more battery swap infrastructure. So this would widen the operating risk before driving durably profitable revenue. And I think when you look at China big picture and NEO's expanding across there, that's a pretty big landmass where you have to continuously expand your battery structure or your battery swapping infrastructure. And then if you want to go into other markets, again, it's just going to be more and more difficult. And that's a lot of cash that they're going to have to burn through. Again, like I said, the China EV market is oversupplied. If growth slows at all from 40 to 20%, say, you're going to have that fixed cost is going to need to be absorbed somewhere. And that's going to be tough because although their economy is trying to come back right now, it's still not great. And they're in a tough spot right now as well. Now, if all of a sudden the CCP injects more stimulus, we're talking about a bit of a different story, more subsidies, that's also possible. But as of right now, I don't see that. The pricing pressure would then intensify and then margins again would compress. So NEO doesn't have that kind of BYD and Tesla scale, like I was said. So just breaking it down for the real bear thesis, the stock would only work if your delivery growth sustains 30% essentially, your vehicle margin stabilize above 17%. There's no major price war, there's no additional dilution. And in my opinion, that risk reward isn't favorable enough for me as an investor to kind of take it. So it's a pretty narrow scenario. That's, I think, the way I look at it.
An excellent argument. Tell you what, I'll let the listeners and the viewers argue it out in the comments. So,
all right, deal.
To everyone watching here today, let us know, are you bull or are you bear? Also, please let us know what company you would like us to do next. And Mitch, dibs picking bull or bear first next time for me.
Absolutely.
Perfect. Look, on that note, that is all we have time for today here on The Long View. If you like today's chat, please like, comment, and subscribe to our channel. That's The Long View. Until next time.